Hey, good morning, options traders, and a very special welcome to all of our new traders. It looks like we just crossed the 1,000 trader mark here in our Facebook page, so that's great to see. And in this video, I wanted to talk about the neutral ratio. It's a mathematical formula. Don't worry about it. It's super easy, but it's one that every options trader must know. So what is the neutral ratio and when do we use it? Well, there's a lot of different reasons why we might look to this calculation, but probably the most common is for hedging positions. So for example, let's say that you have 300 shares of stock. We would say that you have 300 deltas. And what that means is that every time the stock price rises $1, you would make $300. And every time the stock falls $1, you're going to lose $300. That's what it means to have 300 deltas. It's the equivalent of 300 shares. So because of this downside risk, we might want to hedge it. And there's a number of ways we could do it. One, we might just simply buy 3 put options. This is what's called an expiration hedge. And that just is because at expiration, the deltas on that put would equal 100. Technically minus 100, but for this video, I'm going to forget about the minus sign. But if those put options are in the money at expiration, then they will be worth 300 deltas. And again, if we have 300 shares, that's what we're trying to hedge. We would be neutralized at expiration. But what if you need 300 deltas hedged now? That's a different story, and that's where the neutral ratio comes in. So what is this? Well, again, it's very simple. It is 1 divided by your delta. And when I say delta, you need to put this in a decimal form. So just take out a calculator, punch in the number 1 divided by your deltas, and that gives you the neutral ratio. And what it does, it shows how many deltas you need to hedge a position right now. Not at expiration, but right now. So let's look at some examples. Let's assume that a put option that you're looking at for a hedge has 75 deltas. What's the neutral ratio? Take 1 divided by the delta, which is 1 divided by 0.75 or 1.33. So this number right here, this 1.33, is our neutral ratio. And what it shows is that the number of options we need equals 1.33 times the number of shares that we have or that we're trying to hedge. So in this example, we have 300 shares, we're assuming. Take 1.33, again, that's your neutral ratio, times the 300 shares, and we get 400 shares. So I would need 4 options. Remember that each option controls 100 shares, so if we're trying to hedge the equivalent of 400 shares, we need 4 put options. So the way you can think about this is that yes, we have 300 shares right now in the account, but I need to pretend that it's really 400 shares. That's what I'm trying to calculate. So if you think about it, if I have 400 shares that I'm hedging, and each option has a delta of 75, that comes up to be 300 shares. So now I have a 300 share hedge right now. And that's why this is called the neutral ratio. I have neutralized this position. I'm plus 300 deltas, and with my options, I am minus 300 deltas, so right now I am fully hedged. See, that's not the case if we go for 3 put options and be hedged at expiration. All right, what would happen if we had, let's say, a delta of 60 instead? Take 1 divided by 0.60 gives us 1.66. If we have 300 shares, 1.66 times 300 shares equals 500 shares or 5 puts. So as before, even though I have 300 shares in my account, I need to pretend that it's really 500 shares that I'm trying to hedge. Why? Because each put option does not control 100 shares. Each one controls only 60 shares. So if we have 500 shares worth of options at 60 deltas each, there is your 300 share hedge right now. And so again, we have neutralized the position. Now in this example, I made it work out nice and easy. We've got 400 shares or 4 puts or 500 shares and 5 puts. In the real world, that's probably not going to work out that clean and neat. So how do you handle it if you end up with odd ratios? Well, let's assume that the put option that you're looking at has a delta of 0.65. Take 1 divided by 0.65, and now we get 1.54. 1.54 times the number of shares that we have, 300, equals, now it's about 462 shares. See, it's not this nice round number of 400 or 500. And this poses a problem because option contracts come in 100-share lots. I can control 300, 400, 500, but I can't control 462. I would need to buy 4.62 option contracts, and I just simply can't do it. So I could either buy 4 or I could buy 5. If I buy 4, I'm going to underhedge, because if I have 4 puts, each with a delta of 65, I'm actually hedging or insuring 260 shares. Well, maybe I don't want that, in which case I would have to go for 5 puts, but that's going to overhedge me. If I have 5 puts, each with a delta of 65, now I'm hedging 325 shares, and I've only got 300. It's like you're buying more insurance than what you need. So in the real world, this is usually how it works out. You either need to underhedge or overhedge a little bit. Now, of course, we could also go to different expirations and different strikes, trying to find maybe a better fit. But no matter which ones you pick, you are probably going to fall into this problem to some degree. That's a different story, but at least you've got the basics of what the neutral ratio is. And that's what I wanted you to get from this video. So remember what it is. It is 1 divided by your delta, making sure the delta is expressed as a decimal. And it shows the number of shares that the options will hedge right now. However, important caveat, everyone, as the stock price changes, the hedge changes. So this neutral ratio is only good for right now. As the stock price goes up or down, your hedge is going to change. And for that matter, as time goes by, the hedge is going to change. All of those are going to change your options deltas. So really the question that you have to come up with is, do you wish to hedge at expiration? That's an easy one. You just use the share equivalent. So again, that just means if you have 300 shares, buy 3 puts. You've got 700 shares, buy 7 puts. And you'll be hedged at expiration. However, if you wish to hedge right now, that's where you need to understand the neutral ratio. So I hope that helps you to understand it. It's an important calculation for options traders because options were, after all, designed for hedging. And you need to know exactly how many deltas you're hedging. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.